Let's get Bill O'Neill's take. He is Chief Investment Officer for Europe, Middle East and Africa at Merrill Lynch Wealth Management. Bill, great to see you. What are you telling your clients to focus on right now? Because this is it's all a bit of a mess out there, isn't it?
Well, I think the major thing is the recession risk. This is the key call. Are the developed economies, particularly Europe and US, moving into recession? And I think the second quarter numbers really call the question, really, the key issue, is that the beginning of a process of slowing down, or is it actually the end of a process? Now, the sense in the market is it's not the end of the process. Economies will continue to cool. We don't believe there will be a significant developed markets recession.
Why not? What is it? Is it because the fundamentals of many companies are actually not bad?
Well, to some degree, there's been disappointment about corporate activity, certainly in terms of jobs growth. But I think the key thing is that there were a number of deadweights in the economy in the first half of the year. The oil price, the Japanese shock. There was a lot of destocking in manufacturing. Manufacturing got a little ahead of itself at the beginning of the year. The second half of the year should see a number of those actually move the other way. Certainly, there is a policy shock there. I mean, there's been a negative policy shock, both in Europe, particularly in Europe and the US. So my sense at this stage is that we will see a weakening of growth, certainly, close to stagnation in Europe in the second half of the year. But I don't see a lurch into recession at this stage.
Do you agree with UBS, which cut its forecast for the FTSE and the Euro Stoxx 600 yesterday?
I see this in a situation where the markets are really obviously quite focused on earnings growth for 2012. That's the key issue. The market doesn't believe the earnings growth for 2012. My sense at this stage is that the corporate delivery is very strong against a background that has darkened in terms of growth. Certainly, if you look at the forecast for the equity side, yes, you've got to take account of the fact that the risk premium on future earnings has actually dropped. Certainly, the targets need to be pulled back. But for all that, business has been doing a great job of executing.
Now, you're advising clients to move towards, and I'm quoting you here, investment plans that fully embrace global, flexible and dynamic approaches. Now, specifics, please, Bill. What do you actually mean by all that?
There are a number of things. First of all, the key, some of the themes, I think, really, a number of themes remain true here. An emphasis in cyclicals on emerging market themes. An emphasis within the developed markets on quality companies that are producing a solid stream of dividends against a strong balance sheet. Focus on basically those areas where you are likely to see brand strength as being important.
Can you give us some specifics about the sort of companies or the sort of areas that you're talking about?
The sectors, for instance, the consumer discretionary area, some of the major companies that are actually linked to the emerging market story. But also, I think, in terms of asset allocation, a sense really that there's an opportunity here, very different from sort of a buy and hold strategy of yesteryear.
Yeah, you said that's almost history now.
Well, if you go back to the 1990s, essentially, everybody just wanted equities, basically. There was periods in the noughties when everybody just wanted bonds. But I think you need a very flexible approach, a very nimble approach. In other words, it means that within your portfolio, you actually have to assign more of your risk budget to being tactical and to moving across asset classes and within asset classes. For instance, at the moment, there's the general view that within a fixed income portfolio, credit should play a much bigger role now. Corporate bonds, I mean by that, vis-a-vis sovereigns.
Oh, it's interesting. Dividend yields now again exceeding bond yields on several major markets. How long can that carry on?
Well, it carried on for a bit, of course, during the 07, 08, 09 downturn. But it does mark a bit of I would say, a green flag in terms of the prospect of the market stabilising. But we're really very much in a situation where the market is on, as I said in the piece, recession alert. They want a sense of where going into 2012 growth will be.
It's very interesting today because we are focusing a lot on the havens and we're looking at gold. Is that part of your investment strategy?
Gold is a play on fear. It's a play on fear and a lack of normality. I don't know where the fair value for gold is. I really would like to know where that is. We don't.
Yeah, yes, if we all knew that, we'd make quite a lot of money.
With equities and bonds, you have a sense of fair value. Yeah. With gold, it is psychological.
It is. And what about the Swiss franc? Now, it's quite interesting. We don't quite know what's going on at the moment because we know that it's been ridiculously high for so long. It's suddenly dropped off off about 1% in the past hour or so. We don't know what's going on there, but as far as the Swiss franc is concerned, is that going to be a haven for quite some time because of that fear factor again?
Well, my sense is that from the point of view of investment management, it's a very expensive safe haven, you know, and
now maybe
you enter
taking
at risk.
negative interest rates.
Possibly, but I think also the fact that the ability of the authorities to handle this, to actually push back on the buying pressure, is limited. You know, they're limited by the central bank balance sheet, which is limited to agree by the size of the economy.
Bill O'Neill, really good to talk to you. Thanks very much indeed for joining us on Bloomberg today.